But hopefully people have joined now. I'm Amy, I'm editor at Sifted, and we are in for a great, very useful, very interesting panel today on the state of pre-seed funding. We'll be covering both what's going on, what these investors and founders are seeing at the moment at pre-seed in Europe, which has not been hit by the quite such a massive slowdown as we've seen at growth, which has all but disappeared. So we'll be discussing that, and then we'll also be getting into lots of very practical tips on what to do if you are thinking about raising pre-seed funding at some point, in terms of, you know, what needs to be in your pitch deck, what investors to approach, how long it might take, what kind of valuations you might be able to get, etc. We do have a Q&A, so send in some questions and I'll just take them as and when they are relevant. If you have them, please don't make them super specific, make them useful for lots of the other listeners. So anyway, let me introduce my panel and then we can crack on. So I have Tayga, who is the CEO at Debite, which is a corporate credit card company, and they raised a pre-seed of 2.5 million last year, so have been through this process themselves. I've got Unger, who's the CEO of PocketLaw. She's in Stockholm. I think the rest of us are all in London, which is a platform that helps companies with their legal needs. Kira raised a Series A last year of $11 million, but also sees what's going on with other startups that are raising money and need to get some legal documents done. I've got Jannat, who is an angel investor, and I have Maria, who's a principal at Octopus Ventures in their sort of earliest stage team. So we've got all the perspectives covered. So yeah, as I mentioned, please just do add in your own questions and I will kick off. So the general headline seems to be fundraising is pretty doom and gloom at the moment. Is that actually true at pre-seed, or is there still some momentum there? Maria, do you want to kick off?
Yeah, sure. Thanks, Amy. Interesting question. I guess that's why we're here. I think it depends on who you ask. It depends on, I guess, the time you ask. So this is a very fluid response. It might change, but just anecdotally, the last couple of months. And for context, just to give you the lens I'm speaking from, I'm one of the GPs with Octopus Ventures First Cheque. So it's a pre-seed, a £10 million pre-seed fund that invests in pan-European startups. So we really try to back founders at that first funding round. So we're quite plugged into what's happening at that first funding round because we invest alongside angels and we invest across Europe. So we do see a lot of volume and work very, squarely pre-seed. And I would say that what we've seen is a bit of a division in the market, actually. We are seeing, on one hand, founders raising still very competitive rounds, even in the downturn. And you could make the claim that, the flight to quality is happening here. Since most investors are kind of pulling back, the selection is now, very specific, very few, and as such is creating that, supply-demand dynamic from the investor and founder side. So you still are seeing founders raising, strong, large pre-seed rounds. On the flip side, you have founders who are just taking longer. I think across the board, from what we've seen, the era of closing in 2 weeks, it's kind of, we're a bit away from there. Now it's taking more months than weeks. Now investors are just taking their time, kind of taking a bit more due diligence. Even at the pre-seed where there's, very little to diligence, there's element of, looking deeply more at the team, kind of referencing. There's also, I guess, from an investor standpoint, just a bit more concern about runway. And at the pre-seed, whilst you don't have to be in co-capitalized for months on end, maybe say 36 months, for example. I mean, it's very early. You're supposed to be iterating and hitting really strong milestones at that stage. What we are seeing is there is a leaning towards more healthier larger round. So for example, if you are raising a very small round and you're trying to get an institutional pre-seed investor on board, there might be some concern that you just wouldn't have the runway to hit the milestones that you need for the next round. So that's just some of the sentiment we're seeing in the market. But to answer the question directly, I do think that it depends on who you ask. There's a division in the market. Generally, things are taking longer.
Maria, what size of round would you recommend, or does it depend too much on the company and the sector? But if you're saying, what might be too small?
Yeah, that's a good question. Let's think of this from the reverse. So if you think about it, if you are optimizing to be a VC funded startup, you have ambitious outcomes, you want to grow very quickly. I think if you think about it working backwards, if you're raising a pre-seed, in the next 12 to 18 months, maybe say the market's tough, 24 months, you have to raise a seed. Or after the pre-seed, you will have to raise a seed. If you work backwards on the milestones that make sense, of which the market is still very much in flux on what that looks like, depending on sector or industry, you will have to hit certain milestones. For those milestones, you will have to fund them. In our minds, for at least the First Cheque Fund, what we recommend is anything below 500K from, I think bringing an institutional pre-seed investor on board might be a bit tough. And the reason we think of this is, it's not so much that you can't do that, because we do think that it makes sense to tranche your round. So for example, you're raising, you probably will start from angels, you probably start getting those commits in before you think about a VC. But from a runway perspective, our perspective is that you probably don't want to raise anything below 500, just to give you the room to hit the milestones that you need to raise a strong follow-on round.
Great. And Jannat, a question from Benita in the audience. How long do pre-seed rounds take on average at the moment, would you say?
Yeah, it's one of those how long is a piece of string questions, but they have definitely increased in length, like Maria said. In 2021, we were seeing these deals close out in 10, 14 days at times. And as an angel who wants to get allocation, it can be very cutthroat. Now, I would say a good round takes 2 to 3 months. Not to say that anything longer is bad, but to budget for somewhere around 3 months and with some buffer, particularly making sure to get right that you're speaking to the right investors who actually do pre-seed. I know a lot of founders who are finding their way sometimes start by reaching out very, very widespread to, when I was a growth investor, I used to get a pre-seed deal flow inbound, and you kind of say, thanks so much for writing. However, I'm a Series B check writer. So sometimes, when we're talking about that 2-3 month window, it's really about from the moment where you target the right investors and are in touch with the right people as well. So that's important.
Mark, so on that point, Tayga, when you were raising your pre-seed, how did you identify the right investors? What was your process, and did you do anything that you wouldn't do again?
I think I had a different experience because I previously founded 2 more startups. So when I first raised my pre-seed round back in 2014, the valuation was $500K and I raised $50K. So from there to raising 2.5 mil at your pre-seed round was a completely different experience for me. Even if we are talking about the struggles on pre-seed rounds right now, I think pre-seed is going to be the easiest round that a founder can raise in this economic climate. Because if you're raising Series B, C, D, whatever it is right now, you're going to struggle a lot. The round size, the time pass, it's going to be so hard for you. So my suggestion is, if you have a solid background, raise as much as you can raise possible at your pre-seed round, because that's going to give you time to work on your product, to find product market fit, to show other investors in your seed round that, okay, this one is actually working. The customers are looking for my solution, and we are trying to solve one particular problem. Because if you're raising an additional 250K at your pre-seed round versus raising an additional 250K at your seed round, is most probably giving you 5 more months runway as a pre-seed company. So this is going to be my biggest suggestion for founders. My experience was all of my conversations with VCs or angel investors took me 25 to 30 minutes to get a yes from them. And it was a relatively very fast process because they knew what we were doing before and they were counting on my previous experiences and the team and some idea as well. But the idea that we started and we came with Debite is, I don't know, 90% different than what we are doing right now. So we had enough chance and runway to see what's going on and like focus on product. This is what I suggest: get as much as money as possible. With like, don't care about the terms, valuation, whatever it is, and like how much you raise is going to determine your valuation as well. And like, if they are focusing on valuation on Series A, I don't know, 60% because of their exit price, I'm talking about VCs. In seed is going to be like, I don't know, 10 to 20% if they find a good team and good idea and good execution people. So this is what I see. And in the meantime, I see from our customers' journey, because we are focusing on startups and 60% of our customers are either pre-seed, seed, or Series A type of startups. We saw that people are doing it right now. Like every month they are getting more investors in, and we are seeing some safe rounds, like fast rounds in, so that they are trying to get the money in and prove their product market fit.
Interesting. Would anyone disagree with that? Don't focus on the valuation, just raise as much as you can. Jannat?
It's not that I fully disagree. I would just say at the pre-seed, you're setting out your early investors and your early cap table. And what you don't want is to have a messy cap table when you then go on to raise subsequent rounds. So if you are over diluted, i.e. you've given away too much of your company to your earliest investors, it can be very off-putting to future investors who want to come in and say, oh, you've already given away a third of your company to these other investors. So there is a fine balance between the amount of money you bring in and the equity you're willing to give away and how that impacts your subsequent rounds. So
amazing.
It's just a balance to strike.
I can also add on to that, same as with the terms. So valuation is, of course, one of the terms that you would be, negotiating when raising fundraising. But there are also other terms, like in your shareholders agreements and in your investments agreements, that can be important to think about, because once you put something in the shareholders agreement, it can be very tricky to get it out. And if something stands out when you're raising your next round, that might also cause some friction in sort of in that fundraise, which is and which can be unnecessary. And it can be small details they can seem small at one point, and then a year later they can have massive.
What are some of them, Kira, that founders should be a bit wary of if they pop up in a term sheet?
So it can be around like who controls the board, for example, something that you can think about in the beginning where you're like, I don't care about my board, I run my company day to day, like those things that seem small in the beginning. But if you give away control over your board at a very early stage, when basically it's you and your co-founder and a couple of other people, it essentially what the board does is that it has a lot of control over the company. And maybe you don't want to give away all of that control early, and B, it's also a signal in your next round if you're giving away your control. So that can be one thing. It can also be you don't want sort of majority votes on certain number of actions you want to take on your in the day-to-day business. So let's just like considering what are the sort of actually try to understand and read through what does this mean for me. It's a lot of legal lingo and I understand that, but like it can really be in the details. And
so that for example could be something like you needing board approval to raise people's salaries. That might be just a pain in the ass.
Absolutely. Or like certain X% of your shareholder votes to raise your next round. That means that current investors can block you from raising more money. And there might be a reason for like that. You still need you need a majority, of course, but like how big does that majority need to be? So those kind of things that is just important to consider.
Tayga, you've politely got your hand up.
Yeah, I like it, like raising hand thing in Zoom. So I was going by default by saying like raise more as you can possible, but all the comments are completely true. I'm gonna be more simple. I'm gonna say don't give any board seats at your pre-seed round. Don't give any extensive rights. Don't give any rights. It's just like the idea and the people, and like. I believe you don't need to give more than 20% of your company at the pre-seed round, that's for sure. So the more that you raise, it should help you with your valuation, not with the dilution. I know it's tough, but like I suggest people even do like a introduction meetings with different investors all around the world, because an investor approach in the UK versus EU or US or Middle East or like I don't know, APAC is completely different, and it's giving you a sense of like how you can build the next couple of $1 billion business.
Cool. And we've got a question from Joe in the audience, which is, I guess just generally, how do you figure out how much equity to give away? I mean, would you all say around the 20% mark is standard, or is there anything else to consider there?
I'd say 20% is pretty standard. I'd say the best pre-seed rounds that go out there might only dilute by 5 to 10% in the first round, but 20% is probably the upper cap on that, and 20% is what, you know, on a rough model basis you can then say, or seed, series A, B, obviously at commensurately higher valuations will do as well. There are other things that would affect your valuation. So if you have an option pool created on your pre-money valuation, that'll affect your founder dilution, things like that are to consider when you get a term sheet. So just really important, like Kira said, to read it carefully. And then the other thing that may happen in this market that used to happen in markets before is more aggressive share types. So you might have not just preferred shares, but participating preferred shares, meaning that investors can double dip on the amount that they get when liquidating. And they do this if they think the valuation that you want is too aggressive, and they'll say, okay, we'll give you the valuation, but and then there'll be all these conditions under which the investor gets 2 times their money that they put in, or, you know, far more, and you as a founder could be left with nothing. So also important to, like Kira said, think about the valuation and the dilution in context of the share class that is being created in the round.
Yeah, and this maybe slightly touches on Christos's question, but if I'm a first-time founder, I've never done this before, this all is a bit of a minefield, you know, what valuation should I do? How hard should I negotiate with VCs versus, you know, if they're a great seeming investor, give them the valuation, you know, give them the equity they want, etc. Who would you recommend founders go to for advice on this? Is it lawyers good people to speak to? Is it other founders? Is it friendly angel investors? You know, where should someone go? Maria?
Yeah, happy to chime in there. I think talk to VC friends, kind of like low stakes, not necessarily pitching, just having a conversation. What are you seeing in the market? And I think Tayga might have leaned towards this earlier. I think it very much helps for you to be exploratory about your valuation and not set it yourself, like kind of let the market give you a pulse of what's reasonable, because at the pre-seed stage, the truth is the valuation is really not about the value of the company. So many things impact it. It's the VC's expected multiples on what they think they can do. And the ceiling there is the round dynamics between investors and the founder at that time. So I would say like, kind of take a more exploratory approach and try not to price yourself too early. That's one thing I'd say. 2 things I wanted to add to the previous conversation is, especially in this climate where you are more likely than prior to tranche your rounds. So you might go out to, you know, raise around, just kind of like get ASAs, you know, like, or safes, get angels in. Like, we are seeing a bit of a pressure on both sides, you know, lower rounds being raised at a lower valuation that has dilution implications. I think really thinking about your dilution at this stage is going to be very important, because a lot of founders don't really think about it, and then later down the line it kind of bites them and it's like too late, and it's like that can be the reason folks don't invest, but that's sometimes the reason, you know, later stage investors don't invest. So as you're tranching, like just keep an eye on the valuation, because you might give an angel a different valuation and you might give a VC a different valuation depending on how, like you prove milestones. So that's one other thing that I would say.
And Kira, I'm going to turn to you for your legal expertise here, but can you explain for anyone who's listening and is a bit confused by tranching, ASA, safes, what those things are?
Yeah, so I mean, there's so many different instruments in the market, of course, available. I think there's a couple of parameters here to consider, and I think my main advice would be to keep it as simple as possible in the early stages. Yes, there are a lot of instruments. I can talk from what we've done and what I recommend founders in my ecosystem to do, and that is to do a regular price round with issuing new shares. How we did set that valuation was actually, I think, having a very clear plan on where you want to go with the milestones, and then count backwards how much money do you actually need to get there, and also, of course, adding a little bit of a buffer to be safe in this particular market. And remember that at this stage, as we've been discussing, both Jana and Maria said, there is not that much numbers maybe to consider yet in terms of revenue. So it's going to be, they're investing in you, they're investing in your team. So what you need to do is to make the investment feel as de-risked as possible. So by having this very clear plan and then counting backwards and then proving to them that I'm going to be, the best founder out there in the world to make sure that we realize this vision. And then if they want to invest in you, if they buy into that, the arguments for the valuations and the other terms that we have been discussing, for example, which instruments to use, what kind of share classes you would or would not want to introduce, as well as other cumbersome terms, you would argue from a standpoint that this is your company and they want to keep you incentivized, not for 1 year or 3 years, but for 5, 10, maybe 25, maybe 50 years to be running this business. And then you need to have a reasonable structure to do that. So I think so that's in short. And then there's a lot of parameters around this, and how we learned these things in the beginning, my co-founder Olga and I, was that we actually talked to a lot of peers. We talked to a lot of founders in our network that were maybe 2 years ahead of us, and discussed arguments and negotiation tactics and also valuations.
Cool. And on that kind of working back from where you want to get to when you raise your seed, Jannat, what generally should startups try and achieve between pre-seed and seed? What sort of things might go into that plan?
Yeah, and that plan and that pitch is exactly what people are buying into. So you say, depending on where you are when you're raising your pre-seed, might be pre-product, you might be MVP stage or minimum viable product stage. You kind of need to set the tone of what you're going to do. Are you going to launch your product? Are you going to monetize that product? To what extent will you monetize it? Will it be within kind of a beta kind of ecosystem, meaning that it'll be monetized, but perhaps only to a certain crowd that'll give you certain feedback? So really outlining, expectations. Don't say you're going to generate 10 million in revenues by the time you get to seed if that's not going to happen, and usually that's not expected at seed either. So I would say articulating what that narrative is, and then linking it back to why you need financing. So in order to launch this MVP, I need a marketing budget of 50,000 for the next 18 months, and I will spend it in this way. And you don't need to have £4 this month will go to Facebook ads or that level of granularity. But if you do, then it's maybe a bit overwhelming at pre-seed, in fact. but to know exactly what those proceeds are, the uses, and the intended outcome, and linking that together increasingly nowadays in a financial model. So normally at Series A, it's guaranteed that you'll have a financial model in your data room or whatever you use to prospect investors. Now, increasingly, you see it at the earlier stages. That's a factor of the current market, where pre-seed founders, you are expected to know your cash profile, and the life and death of your company is determined by that cash. So linking those together is kind of what's expected to be seen. So where is your product? How does it serve the market? State of market, do you really understand that market? How will it evolve when you get to your seed stage? Is it a nascent market now? A factor of climate that, just as an example, that people are about to understand in the next 24 months and you're ahead of the curve? Or is it a well-known market, something in fintech like payments, but you're doing it in a different way? So understanding that market, and then why you're best fit to serve that and execute on that plan. So I'd say those are the core ingredients from getting from pre-seed to seed, and knowing that journey, whether it's 18 months, 24 months, what have you.
Maria, is that the kind of stuff that you want to see in a pitch deck, or is that something founders should get across when they actually talk to VCs or when they email them for the first time?
I think a little bit of both. I think in the pitch deck, like just giving a sense of how, what metrics you're trying to hit. And I think even more so in the conversation, if we're to take a step back, at the pre-seed stage, a lot is unknown. You are just an incredible founder trying to target a large market, and you're inviting investors to go with you on that exploratory journey of your thesis. You are trying to, in the pre-seed and seed, prove and disprove a lot to prove that there's some early signs of market pull. Now, one of the questions I like to ask founders at the early stage is kind of like, what needs to go right? What thesis are you trying to prove? As a founder, you have a thesis to the market. Sometimes it's spot on, very, very many times it's wrong. But there is something there that through experimentation and iteration, you validate and you get a pulse of the market. And then you kind of see evidence and data that you are building something that the market wants and is likely to pay for. So in my mind, I think that's the perspective to take between pre-seed and seed. You are trying to validate certain theses. It is very refreshing to hear founders think and express very much from that high level of what they're trying to prove and what that means in their journey of building this potentially billion, pound dollar company. And then also putting some kind of hard facts to that, just to show that you are thinking tactically as well as strategically. So from a distribution standpoint, how many customers do you want to have closed, or do you want to just have monetized? Do you want to have 2 LOIs from like 2 different sized, companies to test certain things? So just some rationale that shows that your thesis to the market is being proven through iteration or disproven, I think is critical at this stage, because at this stage for us personally within the First Cheque Fund, we don't ask for a financial model, because while it's a very useful exercise for you as a founder, we just think it's way too early to tell. Whatever is in there is probably just like, just like is a suggestion. I would say it's usually very far off. So yeah, those are just 2 cents I wanted to add to that.
So Tayga, when should a startup raise pre-seed? Like what do you need to have hired someone? Do you need to have some money? Do you need to have a website? Like what are some things you're gonna need?
I think it's depending on 2 different outcomes. One, if you already built something before versus this is going to be your first company. So if you already built something, you can easily raise money by saying that this is who am I, and this is my team, and this is the product that I want to build in the near future. And if I can build this, this is going to be the success metric. And what am I going to disrupt is this one. I did something like that, but now like it's more about, if you're going to go in front of some investors, you need to be able to show them something, maybe an MVP, maybe a small product that is working properly, or like something that people are looking for. It maybe like a big wait list or whatever it is. So like the more traction or the more tangible things that you have is going to help you to raise more money. But imagine that like pre-seed is mostly on the founding team. And everyone is counting on that team is going to deliver the promise. And that's what I want to add as well, because we are, I think, missing one point as founders, because the dilution is not only for investors, the dilution is depending on the stock option plans as well. So like at pre-seed level, you're not going to pay your team above market rate because you don't have money, but the bigger option pool that you have is going to help you to hire the best people in your team, and the strike price is going to be relatively low, so that it's going to be a very, very advantageous thing for the next teammates. So like we diluted around 8% at the pre-seed round, but we have like a more than 10%, like a bigger option pool for our early employees, and we used it a lot. And that's how we incentivize the best people, because like this is what you're gonna sell at your seed round as well. Hopefully you're gonna raise your pre-seed round successfully, and you're gonna say, okay, with the money that I got, I built this product that my customers like. But in seed round as well, this is my team that is gonna deliver the product market fit after raising my seed round. So this is what founders need to focus right now.
Like, Kira, how did you present yourself as a founder to investors? You know, this, correct me if I'm wrong, but I think this is your first company. What was the way you tried to build confidence? You know, I've never done this before, but trust me, I'm going to be good at it.
That's a really good question. I think I'm lucky to have been a little bit naive in the beginning and not really maybe understanding the scrutiny that you would face. That might scare some people off. I think my biggest advice is to make sure that it's that you come across as someone who is really honest, transparent, resilient, and determined to this vision and this mission that you're on. So being genuinely yourself, but do have a way of talking about your background, and actually why, again, you are the person that will be the best one together with your co-founders to be solving the problem that you're out here to solve. And then things, then you'll get the credibility based on that.
Nice. Reminder to the audience that we've got loads of questions. You can upvote ones, so then I know which ones to definitely ask. But this is another one for you, Kira. I found this quite funny because I experienced this myself, which is in Sweden, it's going to be the summer holiday soon, and then VCs aren't going to answer their emails for a few months. Is that the same around Europe, or do VCs work through the summer? In my experience, Kathy, many VCs do take nice long summer holidays, so it's often not the best time to contact people in France, Italy, Spain, or the Nordics. However, the ones in the UK seem to have a much less healthy work-life balance and are more or less there all the time. Does anyone else want to add to that?
No, that's probably fairly correct.
Yeah, so maybe just don't time your pre-seed raise at quite that moment. But we sort of touched on this earlier. There's another question from Kathy, but when you're thinking about which investors to go after, how should people be thinking about a mix of angels, first check VCs, solo GPs? We've angel syndicates or sort of individual mega angels. What's like a nice mix, or should they not be thinking about the mix? Should they be thinking about domain expertise, or where they are geographically based? Who wants to take that one?
I think it's always trying to go to the next level, which is the next round for founders. So if you're going to prioritize someone, that someone needs to be the one that's going to help you with your missing points. Like if you're looking for an expertise on the product side, get an ex-product guy as an angel investor. If you're looking for some initiator, that means have a great network over the other VCs. Have someone like that and fill your gaps with the right people. That's what I can say.
And I can add on to that. I agree, and also it's a really good question, because I come across a lot of founders that tend to like maybe not actually think enough about this question about who you bring in, because it's really important to keep in mind that whoever you bring onto your cap table, they're very likely to continue being there for a long period of time. So that means that you really need to consider, is this the person that will help you sort of succeed, or at least be supportive on your journey? Because it's like it's more than it's like more than a marriage. It's more like having a kid together, because you're gonna be stuck together for a while. So what I would really consider is as Tayga said, like the knowledge, like does this person provide you with some kind of knowledge that you don't have access to or that you want? It can network is the second one, and depending on whether you're raising from this person to get access to knowledge or to get access to more money, you would also need to consider sort of that size. And then lastly, always keep in mind, is this someone that I think that I can work with for the coming years and who I want to associate with the business that I'm building? And from what I hear, and like from maybe not from personal experience, but from talking to a lot of founders about these questions, the smallest investors tends to be the trickiest one to handle. So don't think that you can like bring in someone there and then another one there and then someone's dad's friend there and like just scrapping together, because then if I were you as a founder and you were struggling a little bit with finding like that first, like to raising that pre-seed, I would find a way to find more time to make sure that you build your cap table in a very conscious way.
Yeah. And Maria, how if founders are a bit confused about whether an investor might be one that would be interested in them, what are some ways that they can sort of pre-vet investors? I mean, there's obviously, if you're a fintech, have they ever invested in a fintech before? Or do they seem to only invest in climate techs? Then they're probably not a good fit. What are some other ways to gauge whether this person wants your email?
Yeah, great place to start. Fund fit is the first thing. And I understand that this can be a bit difficult because some funds are like generalists, but they're not really generalists. Like they invest in certain things and not, so it's hard to find out. This is where it kind of helps to connect with potentially founders they've received investment from, or folks in the founder community, or VC folks that you kind of know, because they're usually more plugged in on what certain funds tend to lean towards. The other thing I would say on the angel bit is, from a pre-seed VC standpoint, it often is very validating when you have an irrelevant angel on your cap table. It's a bit of a pre-vet, it's a bit of a signal. So for example, if you are in the fintech space, maybe payments, and you do have an angel, and it doesn't have to be a superstar angel, because a lot of people, want to get the huge names in the table. It does help, but even if you don't have that, something relevant that says this person is an expertise in their field, saw your idea and thought to back it. There must be something there. And oftentimes at pre-seed level, there might be some diligence just chatting with them through their knowledge. And whilst it's very much a team play at that time, is also a strong signal if they believe you can build something, in that space. So I would say relevant angels is a good place to start to just build that credibility as you make the case for an investment. The other thing I would say is, like, whilst I think as a VC community, we can be a bit more open just to receiving cold inbounds and paying attention to them. It is tough, but I think that there are amazing founders who don't necessarily have the networks, but it doesn't have any implication on whether or not they can build businesses. I think it's just the lack of, access. I think really clever cold inbounds can work, and I think also mining your network for relevant connections. So you might even have 2 or 3 level connections to the folks you're trying to meet. With each person you're hoping will introduce you to the next person, treat that person as a pitch. Because if they feel strongly, they will, share that. Everyone is, trying to make sure that whatever they pitch is something quality. If you're able to kind of get them on board, you'll be very surprised at how very quickly people can advocate for you across the chain. And I know that, VCs are one of the most time poor people. I mean, yeah, but I think it also helps to back channel, getting a few people to ping it. And then okay, I've seen this 3 times, probably should pay attention. So pretty much playing a little bit of that game, but I think the persistence, when people say, oh, don't be too persistent, I think be persistent. I feel like if, get that conversation, because sometimes, you know, a deck is very different from a conversation, and it also shows resilience that you will sell, you know, to customers that way, or sell to high quality talent that same way. So yeah, those are a few thoughts on that.
Amazing, great points. I find this question really tricky when people ask it about pitching to journalists, but what is a good cold email or message to send to an investor, Jannat? And can you remember any memorable ones that, you know, really stood out?
Yeah, I'd say the best ones are when you've actually really tried to understand the investor as well. And I know founders are time poor, so it really shows when you show up and say, hey, I really like that thing you wrote in that blog. It resonated with me and I implemented that in my startup. By the way, I know you like B2B software and you worked at this company and you invested in this company. So here's something I'm building in the space, and really curate each message. I think the worst ones are the ones where, you know, it's dear insert name here, and yes, you're time poor, but you've given us a mail merge that perhaps you've sent to 500 people on a mailing list, and most of us just kind of ignore that. But the ones that are really thoughtful have kind of gone to the trouble of finding out the kind of professional work we do and taking an interest and finding that commonality or that common link in the message, and those will always get a response, even if, you know, that there's a reason why. Maybe I'll say, actually, I'm conflicted. I invested in something very, very similar recently, so I can't take this conversation forward, or something like that. You'll still get a response. So I'd say the ones where they've referenced work we've done before or something we've said, or those get the most attention. So really being curated, personal, and feeling more like a conversation rather than just, you know, a pitch where you see an email with these 5 key bullet points and all of this stuff. So the irony is the best pitches don't feel like pitches. They feel like, you know, we're getting to know each other, we're having a conversation. So almost starting that conversation with that kind of, I've made an effort to get to know you, would you like to make an effort to get to know me vibe. Those are my favorite.
Yeah, and I'd say that's true as well. If you want to pitch to a journalist, give us a little bit of flattery and show that you've paid attention to who we are. Question from Noor, and everyone, please keep questions coming and keep upvoting them, because there's loads now and it's hard for me to trawl through them all. What is the best way to reach out to a VC? Kira, what ways did you have most success? LinkedIn, email, Twitter, ambushing them at a wine event? What works?
So I think what has worked best for us is through common connections. So actually being, you know, shameless with your own network, with like reaching out to someone who knows someone that you want to be connected with, so you get a warm introduction. That has by far given us the best results. So on that, from my experience and from what I've heard, founders are very generous with introductions. So do not hesitate to ask. At least the Nordic ecosystem, and from what I know from the UK as well, people are very happy to help. We've all been through sort of the same journey. So if someone, in my opinion, is a very paid forward culture that should be leveraged, particularly in these times.
Amazing. Tayga, any other ways that you found success?
I think the best way is to find someone who that VC is already invested, because that's the best introduction. One of their portfolio company founders, if they're saying that this is a great person, that's why I want you to meet, that's the best. I think the second part is it could be the people who wants to invest in your company, and they kind of need to prove themselves to you, because like if someone is going to invest in my company, they need to show me that what else they are providing, so that those introductions is always helping me, and I value it a lot. And if you're going to do cold reach emails, that's definitely working. If you have the right structure, the email shouldn't be like you didn't need to scroll down. Like the whole email needs to be in the opening page and giving you who you are, what you are building, what are the key facts that you are doing differently, And 100%, it needs to be something personalized, because why you're sending that email is the most important thing. Did you listen to one of their podcasts? Did you see a correlated investment? If it's related with their background, you have to specify that in order to differentiate from the other founders, because like as founders are cold reaching to investors, lots of like associates, analysts are cold reaching out to founders as well. And as a founder, I generally don't reply to the ones that, yeah, I heard great things about Debite, because like it's just like filling up the quota thing kind of. So if I see something, yeah, we invested in this, and we know that this space is going to be competitive, that's why we want to meet, I 100% go back and talk with them. So personalization is the most important thing.
Amazing. So many good tips coming out of this. And we will be doing a write-up of this talk and sharing the recording on the website if anyone hasn't scribbled everything down. Also on sort of getting in touch with VCs, Sean has asked whether posting very frequently on social media, specifically LinkedIn, is a useful way to appeal to investors. Jannat, what do you reckon?
It depends on what you're posting. So there's kind of a fine line. I specifically didn't invest in a couple of founders because they were posting too much. As first-time founders who had been founders of a business for maybe 6 months, they were posting advice on how to be a founder, when I thought that would have been time better utilized, building the business. So it depends on what you're posting. I would say if you're clearly posting to promote your business, increase sales, hire, recruit, doing all the things that really help your business, rather than promoting yourself too much as an individual, yes, it can help, but within reason, because you also don't want to post so much that people think you're not actually focused on your day-to-day work. So it's about striking the balance and the tone of what you post as well. There was recently a Sifted article saying that the best VCs don't tweet so much. So maybe the best founders don't post on social media as much. Amy, maybe that's a Sifted article coming up. I don't know.
Yeah, no, we did also have an extremely funny column by one of our writers, Aina, that was slightly targeting certain people that we may all have seen on LinkedIn who post perhaps more than is wise. In terms of while you're actually fundraising, this is one for you, Tayga and Kira, what advice do you have for founders in terms of how much of their time they're going to need to dedicate to fundraising during the fundraising process, and what they need to warn their mums, girlfriends, co-founders, employees about in terms of how much of their brain and energy this is going to take up?
Yeah, it's a really good question, and sadly it takes up more of your time than you wanted to, and when it's not taking up your time, it will also take up headspace, so you'll feel a bit distracted. So my best advice here would be to plan quite rigorously, well in advance. So plan your preparation work before you go into the fundraise. This is actually a general advice, regardless of how much time you have or not, to be as prepared as possible when you start reaching out to VCs and if you are like actively fundraising. So preparing the decks, preparing the story, preparing potential follow-up materials. This will save you time, because then you can distribute this work over the course of the months ahead of that. And also keeping in mind that going into the fundraise with the attitude and remembering that the fundraise is not the purpose of your existence. The purpose of your existence is to run this business, regardless if you're going to be funded or not. Like, at least to me, that's the best attitude. You cannot change the world. You can only decide what attitude you have towards that. Because if you can continue reaching the milestones that you've set up together for yourself or for your team, and you'll hit those milestones, you'll also have a very genuine momentum in the business. So whenever you go out fundraise, you can actually also update investors between, the first call and the second. You already made some progress, and that's going to be a great leading indicator for the investors that you're doing something great, and that you are, that you're good at executing. You have an understanding for the speed, determination, never giving up. So this will eventually create a very real and intensified FOMO, which is essentially something that will help you in the process and in closing round.
Amazing. Yeah, FOMO, key ingredient of this ecosystem. Tayga, anything you'd add?
As the founder, you have 3 jobs. One is hiring the best people, 2, help them to work together, and 3, never run out of money. Basically, the third one is always takes more time. The other 2 is relatively easier and let's say funnier. But the moment that you close your pre-seed seed Series A round, next day you start fundraising again, not actively talking, but the moment you close your round, there are going to be more incoming VC interest. So you have to use it. But I agree with Kira. So you need to be super structured, wait until the right moment, keep all of your potential investors informed. That's what I do. Quarterly updates to the ones that I already met. And the moment that you feel ready, or maybe you're not ready, but someone else wants to lead the round or whatever it is, when you have the signal, go for it, close in the 4 or 5 weeks time thing, and then go for the next round. I know it's not hard, it's not easy, but this is the perfect way, I guess.
Amazing. And what about advice on the logistics of raising a pre-seed? Do they need lawyers? Is it a good idea to use something like seed legals or something like Vauban or Odin to roll up angels? Jannat, what are you seeing work quite well at this stage of fundraising?
Yeah, absolutely. I've done a few deals now across Vauban, Odin, Seed Legals, Angel Lift, although I know it rebranded, the name escapes me. So as an angel, you do get invited to a lot of these platforms. So if you are engaging with angels and post-term sheet, you get to a stage where you want to put them essentially as one line on your cap table, have it nice and clean rather than dozens or hundreds of individuals, then these are really great. They do have fees, so just make sure you understand the terms really clearly. I would say when you're in the earlier stages, up to term sheet, you probably don't need any legal advice unless something else is going on, or maybe you're actually setting up structures around your company, or reasons you might need to engage with a lawyer is because your company is domiciled somewhere and your investors are telling you, actually, I need it to be in the UK, or I need it to be somewhere else, so maybe you need to move it. So that's when you might want legal advice before actually closing a round. But usually at the point where you get a term sheet, make sure you do engage in legal advice. Then seed legals have seen, thousands and thousands of these. So, do engage with professionals. I would say that that's probably the first point in time where you really need to engage with lawyers, and also absolutely make sure that the lawyers you engage with aren't just some solicitor, they really do know venture, because the worst thing on the other side is when you have a qualified lawyer, but they don't actually understand venture. It is or business funding. It's a very, very nuanced subject. So somebody who does wills and testaments or conveyancing, that they're not going to understand this. So do make sure you go to a specialist is really key.
Amazing. Right, so we've probably just got time for a few more questions. So I'll do a few quick fire ones from the audience. Ask them now, upvote them now if you have any, or forever hold your peace. Lara says, is there an ideal number of years to have been in business for before you raise a pre-seed? Or can you have been in business for too long to raise a pre-seed? Maria?
Yeah, this is a good question. And I'm going to be honest, there is a heuristic, with VC, that the longer you are in market and haven't hit strong milestones, or raised, the likelier you're not, a fit for venture and the returns. Because if you think about it from a fund perspective, it's not just so much the growth, it's also the speed, because there's very direct IRR implications on that, like from a fund management perspective. So to answer your question, yes, when you do, think of a pre-seed round, delaying incorporation as much as possible till you have to, and then once you do, kind of hitting really good milestones that show progress. And it doesn't have to be, in my mind, like it's just you validating and proving that this thesis you had to market, you are, really finding what the market wants. So I would say that there is an element of trying to move quickly. That being said, I do think there are incredible startups who go on to be amazing without fitting that heuristic. So I will take it with a pinch of salt. It's probably going to be a longer road. It's probably going to be harder, but I would argue that sometimes the returns are probably worth the risk. There are startups, especially consumer startups, that took quite a long time to hit product market fit. Notion, for example, you have examples of people who really took time and didn't hit milestones, but eventually went on to. So yeah, that'd be my
Great.
response.
Jannat?
Yeah, I just add to that. I think Maria gave a great response, but there are obviously a category of companies, what VCs call bootstrapped companies, meaning that they don't raise external capital. If you are doing extremely well, on a bootstrap basis, are you not taking an external capital, and then you're operating in a vertical that VCs like, and then you say, you know what, I want to accelerate this growth, I want to make something happen, I've been growing reasonably well for the last 2 to 3 years, I've built something from nothing. VCs also love that story. They might not call you a pre-seed investment at that stage, and you might actually qualify for something that looks more like a Series A, depending on your revenue level. So there's also that path of just DIYing it, and VCs love this because it shows that you know how to get a lot out of not very much, and they know that then if they were to invest in you, provided it's in the vertical that they're interested in a big market, that they know that they can trust you to use the cash effectively, because when you didn't have any cash injection, you did so much. So I would say if you are bootstrapped, maybe depending on, if you're getting to kind of 1 million in revenues or something like that, you're probably out of the category of pre-seed. But if you have that growth profile ahead of you, VCs still definitely want to talk to you.
Amazing. Okay, final one from me is probably a bit too long a question, given we have 4 minutes left, but we've talked a lot about VC funding. What are some other non-dilutive kinds of funding that pre-seed people could go look for? But let's make it brief. Kira's nodding.
Yeah, no, because this is something we did. So we actually, when we started PocketLaw, we got a financial grant from the innovation sort of office here in Sweden called Vinnova. We got 200,000 euros from them to develop our first beta version of the platform. There are other financial grants, both on, I think, national level, but also EU level, depending on what kind of business you're building. So I will definitely recommend exploring that as well. That also actually gave us a lot of credibility when going into the angel or pre-seed round that we did 6 months after that.
Amazing. Any other types to look into?
Here we have, I think we are one of the earliest backers of startups in the UK. Nearly 20% of our customers are pre-seed companies. It's a good way to extend their runway by using our product when no one is actually giving you like £1,000 credit card. We are trying to support those potential winners, and the whole idea is betting on those successful founders is to grow in the near future, and we can help them to grow faster and extend their runway. So if they're looking for raising pre-seed round, they can come Debite and we can help them.
Amazing. Okay, right, now we actually have run out of time. So thank you so much, all you panelists. So many very wise points, like speak to founders who've been invested in by a VC before, ask them for an intro because they will be the best sort of ambassador. Think about where you want to get to with the money you've raised and then work back. Focus on, making sure you raise enough money in this one go rather than keep on going back. and many other things that I've forgotten right now, but we will be summarising in an article that we'll put on the site along with a recording of this webinar in a few days' time. So yeah, thank you so much, panelists. I've learned a lot. Seems like the audience have too. We got through loads of questions, and people listening, please come to our next Sifted Talks. It's on Wednesday, the 7th of June. If you're not on holiday because you live in France or wherever we'll be on holiday by June, it's about how VCs are measuring success in the downturn now that, you know, the unicorns have all run away and things are a little bit different from how they were a few years ago. And that's it. Thank you so much. Have a good rest of your day.
Thanks, everyone.
Thanks, everyone.
Bye.
Bye.